to therefore are your relatively smaller ticket loans. Your credit card, of course, they get into credit card spends. Hopefully, people are not getting into credit card debt. What are the big no-nos? Personal debt, unsecured, and credit card debt. Would you say that big no-nos?
Absolutely. To begin with, to roll over a credit card outstanding is one of the most, unproductive or a most, I would say, a biggest mistake that a person could do is to roll over your credit card outstandings, because that entails an interest of almost 30 to 40%.
Yes.
So you don't want to pay that kind of and then again the credit history gets negatively impacted. Okay, so that's one that you avoid by all means. The other is the personal loans and the unsecured loans, because they come at a higher interest rate. Invariably, they would be in between 14 to 18% is what you're going to pay for an unsecured or a personal loan. The third, of course, as much as anybody would say that these are zero interest
buy now, pay later.
Buy now, pay later. Those websites will entice you to say that you spend now, pay later, and these are zero interest. Nothing in life comes for free.
Yeah.
Okay, they're very smartly packaged offers to you that you don't realize that you're actually you're paying for it eventually. So these travel portals where you go in and you say that you go on a luxurious holiday, exotic holiday, and you just pay so much EMI. I think that's the problem that people are falling into, to say that, look, I'll go on a holiday now and pay it over 6 months out of my salary. I don't think, why don't you go for a holiday after 6 months?
Yeah.
I mean, accumulate it and save it up and spend, because holiday is certainly not a thing that you'd want to spend by taking a loan. I don't think that is even reasonably making any...
Set up a travel fund.
Travel fund, I mean, and travel is not something that you need to take a loan for. I mean, if you're falling into that zone, then there is something that you need to be careful about. You need some kind of guidance and consultation to come back out of this. Because if you're going to spend on a holiday out of loan, that means your other priorities that are there in life are not going to be taken care of.
Okay, so we've discussed the quantum that your EMI should be, not more than in your income. We've discussed what type of loans you can consider taking. Let's also consider, if you have loans existing, how do you knock them off? And how do you dramatically reduce your interest cost? Obviously, by paying lump sums, but some people have also talked about paying one extra EMI every year. It's a simple concept. A lot of people diss it on social media. I've seen this as well. But it is a powerful concept when it works.
Absolutely. So it's nothing, no rocket science. I mean, we as Indians have been, have grown up with these money habits.
Yes.
Quite honestly, even if you're a family of engineers, still your parents will be telling you to be prudent with your money.
Yeah.
So they will tell you that, don't spend XYZ amount. If you've taken a loan, try and repay. So that every time that a person gets an increment in the salary, why don't you ever consider increasing your EMI? Okay. So you fixed your EMI at the beginning of taking the loan. And that is for, say, probably 15, 20 years. Why don't you go back to your banker and say, look, I want to increase my EMI by 10%.
So bankers are not going to thank me for saying this, but a lot of them will say, increase your tenure and not your EMI, because over the course of a longer tenure, your interest cost goes up.
Absolutely.
So the bank earns more.
We just discussed this.
Exactly.
Over a period of 20 years on a loan of 1 crore, you're paying 1 crore 16 lakhs as interest.
Yeah.
So obviously, you're paying more than the principal that you borrowed. So you need to go back to the bank and say, look, I want to increase my EMI by 10%. Let the interest rate be constant. I mean, the tenor be constant. Let me just increase my EMI. The other concept very popularly is that instead of 12 EMIs in a year, you pay 13 EMIs.
Yes.
Because you get a bonus, you get a performance-linked incentive, you get those lump sums. So just go and prepay, one additional EMI every year. You see the magic when their tenure reduces considerably by just one additional EMI. Or additionally, when the interest rates are going to fall, and then an offer comes from the bank saying that, look, hey, the interest rate has fallen. Do you want to reduce your EMI? No, you keep your EMI constant. So automatically the tenure of the loan will come down. So you'll be able to repay that loan faster. The net interest burden on you will come down.
Yeah.
So of course, you need to evaluate well within whether it's a productive loan or an unproductive loan, all those kind of things.
The last thing I want to talk about is a lot of people are still on the marginal cost of funds lending rate, MCLR, which was used after the base rate regime, because it was felt at that time by the Reserve Bank of India that banks were not passing on the interest cuts and raises that they were doing, more raises than cuts, or more cuts than raises rather. And now it is the benchmark linked prime lending rate. And so therefore, a lot of people are being incentivized or being asked by their banks to switch over to the benchmark linked rate because it resets every month.
Correct.
How do you how do you decide when you want to shift? Because MCLR does not reset very quickly.
So RBI has been prudent on this context to whip the banks on this, to say that, look, you keep coming to us and saying the interest rates are high, because of which XYZ, we're not able to lend and all those things. The moment RBI reduces interest rates, they'll be very, very notorious in passing it down to the...
Very quickly.
Yeah, they're very notorious in that. Let me put it without mincing words. I mean, they don't very, wholeheartedly pass it on to the...
When they raise interest rates, they do very quickly, and when it's going down, they don't.
They don't do that at all.
Yeah.
So it's on the borrower to be prudent enough to go back to the bank and also flash the credit score that you have, that, look, I've been honest and I've been paying everything well. Then why aren't you offering that benefit to me?
Yes.
Now, the two choices, the banks do not pass on entirely. The other is, then otherwise you have to move your loan to another...
You can shop for a loan.
Yes, but there's a cost to that. So there's a processing fee. Then you have to evaluate whether that cost of moving the loan...
It's usually a percentage of the remaining
about
principal.
0.25% odd. Plus there is a process to follow, right? There's there's going to be a whole lot of things to do. So it's not the most ideal situations to be in, right? Because there is a cost incurred. So then you have to get into the cost benefit analysis. That if I'm incurring that lump sum cost against the interest that I'm going to save over a residual period of time, is it worth it or not? So moving to anything that helps you save interest, okay, and if it's more efficient way of transmitting the reduction in interest rate to the end borrower, I think you should be prudent enough in doing that. So if you're asking your borrower to move from MCLR to the benchmark linked rate, yes, I mean, most certainly go ahead and ask your bank to do that for you. If there is a cost, sit back and evaluate whether that cost benefit analysis makes sense or not. If it does make sense, then please do that, because every interest that you're going to save is as good as money earned.
Absolutely.
Right, and over a long period of time, it's like compounding. So you're compounding a negative impact of high interest rate. So might as well have it reduced to as much as you can.
Yeah, we often talk about compound interest and the compounding of your wealth over a period of time. Not very often do we talk about the compounding cost of interest. All right, so Harsh, hopefully we've given our viewers some perspective on how to manage their interest cost, because really we speak about compound interest and what you earn, but often you don't talk about what you incur, and that is also compounding, as Harsh has pointed out.